So today we have Phil Compton. Thank you for coming uh, as our speaker. He is the Chief Financial Officer for Locomation, an autonomous trucking company with CMU roots. He has also served in a similar capacity for several other Pittsburgh area tech startups. Phil has significant financial and operational experience in building the team, infrastructure, and profitability of rapidly expanding companies. He has helped raise over 120 million in venture capital financing, leading to acquisitions of 4 of his former companies. Phil is a certified public accountant and holds a bachelor's in accounting from West Virginia University's Chambers College of Business and Economics. He is also an ongoing guest speaker and mentor at Carnegie Mellon University Sports Center for Entrepreneurship and serves as an advisor to several Pittsburgh startups and entrepreneurs. So Phil, I'll let you get started. Thank you.
Yes. Yeah. So, hey, everyone, I'm Phil Compton. This is, I think, the 10th time I've done this, so quite a bit. And I am going to go ahead and share my screen. And, oh, so you can see, everyone can see the presentation now?
Yep, looks great.
Okay. There we go. Yeah, so yeah, this is financial modeling, and we've got an hour here, so I usually always run out of time, so I'm going to try to watch that better this time. So I'm from WVU, West Virginia University, about an hour south of Pittsburgh. So if this was Pitt, I would be talking about the backyard brawl, but it's CMU, so we don't have any rivalries. I'm the CFO of a local autonomous trucking company called Locomation with an A. And all of our founders worked out of the out of a division of, well, an affiliate of CMU. So they have CMU roots, and a lot of them went to CMU, and one is a professor at CMU. So we are involved in autonomous trucking. You've heard of autonomous vehicles. We've applied it to trucking, and in particular to commercial trucking on highways. So a lot of heavy lifting. I've been in a lot of early stage companies, and I'm on the path for another one here. So been through a lot of them. I'm a CPA. I'm an entrepreneur myself. I'm an investor, and I'm an advisor to some local companies. I started out my career with Big Four public accounting with PricewaterhouseCoopers. I then went to a company called Black Box that used to be on the NASDAQ. They're no longer. And I went through some crazy transactions there. A leveraged buyout, which is today called private equity. I went through an attempt to go public through an IPO, and we made it to the day before we were to go public, and the transaction unfortunately didn't go forth. So I did all the work and got none of the benefit. And then I took them through a very successful bankruptcy. So I've been involved in a lot of life cycles of companies. I've also been with WiseWire, with another CMU related company, in fact, a CMU spinout, co-managed in the early 2000s, Netronome in the mid 2000s, and Malcovery Security was a cybersecurity company that I, even as a CPA, helped co-found in 2012, and we sold that company in 2016. So that was one of my exits. I also helped sell that company, WiseWire, to another bigger CMU spinout called Lycos. Lycos preceded Google in the mid 90s, and it was a big name, and it was certainly big in Pittsburgh. That company bought WiseWire for 40 times revenue. So can you imagine today a company being valued at not 4 times their revenue, 40 times their revenue? So those were different days. Those were fun days. I wouldn't mind going back in some ways. So that was a really interesting transaction. I've helped raise venture capital funding of about $120 million. It went up again last year. I've been involved in all sorts of financing otherwise. I helped to work on deals to close business in terms of sales contracts. I'm usually the face of the company when it comes to dealing with investors, and I've run a lot of board meetings, so a lot of different things. And I'm very active in the local tech community. So let's move on. But we're here today to talk about financial modeling, and we're going to have three sections. One is building the model and some of the planning and considerations you need to take into account when doing so. Stress testing your model, because the model is only as good as the formulas and the interactions you have built in the model. And then at the end is an interesting section on your initial funding round and the cap table. So that's always a real mysterious thing, and I'm going to try to make it a bit more friendly to you. So talking about building financial models, in terms of a horizon, your first model should, and again, you're building this model not only for potential investors, that's a very good use of it, but you're also building the model to run your business and to plan when you're going to do a myriad of things, and to plan when you're going to embark on fundraising, and to plan on how much you need to raise in that fundraising and when the next round is. So the model is valuable both internally and externally. Typically, you would have detail by the month for the first 2 years. And I know that sounds like a long time. My gosh, I'm just starting the company and I have to project, months 1 through 24. That's advisable, because you don't just want to plan for the next few months. You want to look at the, relative near term of 2 years, 24 months, so that you can always see kind of the landscape out in front of you. And that will give you better insight as to when you need to hire people, embark on a more ambitious marketing program, perhaps, when you need to bring in partners to help you sell your product, and of course, when you need to raise money. So what kind of company are you planning on? Excuse me. And I shouldn't say what kind of company, but what's your focus? If this is your initial funding round, then it's getting off the ground. So you got to get off the ground to get started. So that might be the purpose of your initial model. Is it for a subsequent round? So in other words, how have you deployed capital in the past, and how much do you need to raise this next time around? And what progress can you show investors that you've achieved and spent their money well? And likewise, what milestones are you going to be able to achieve out of additional funding? While you're planning, are you looking to build the company to sell, kind of like flip it real fast? So kind of a shorter term focus. Or are you building a company more for the long term? Building a company to sell and flip fast, that might work with a fix-up house. That's a lot more problematic with a company. Are you building a company to go public? Well, if you haven't even hired your first person, it's hard to even think about going public yet. And while that can be a worthwhile goal eventually, I would suggest to you that, doing a public offering is not what you should be focusing on starting out your company. But then along comes the word SPAC. So I'm not going to cover SPAC a lot in this presentation, other than to say it hit everyone's awareness. It really jumped on the scene about last May or June. So we're coming up on, close to a year. And a SPAC is a special purpose acquisition company, whereby, real simply, a group of investors or financial professionals, or even Shaquille O'Neal or Jay-Z, gets monies and investors together, filed to go public. So it's a public entity. And let's just say, the ticker is Jay-Z. I'm throwing that out there. It's kind of silly. So you've got a pile of money. It's called a blank check company. You've filed to go public. You now report to the SEC. You've got a pile of cash. Those companies, those SPACs, are then looking for targets that they can merge with, so that those targets then become the public company. And that is a way for a private company to backdoor or back end their way into being a public company. So you didn't have to go through all the typical IPO process, but yet eventually in the end, you end up being public anyway. So again, I'm not going to go into that. That could be easily an hour on its own. If you Google the term SPAC, if you're not familiar with it, get ready for a lot of results, because it's red hot to white hot right now. That's how hot that space is. Or are you building a company for the long term and seeing what happens? I would suggest to you that's the best path. If you build a company that has a desirable product or service, it can be a service too, that has a reasonable addressable market, or a TAM, as you might hear it called, and you're able to entice customers, a few customers, to buy, and then they derive benefit out of that, and then they buy again. They, you upsell in them and they buy again, and they even refer to other partners, and they actually pay you for the product or service, and then they renew their services if it's a subscription later. And if you become profitable, you've built a great company. Believe me, if you've built that company with those 10 characteristics, options will come your way. So you will have opportunities. So that I suggest you build the best company you can, and then see what happens. Let's keep going there we go. You need to be realistic in your numbers. I've seen a number of projections that are like, well, we're not going to have any revenue our first year because we're building the product or getting the service ready. And we're going to have about $500,000 in year 2 because we're still ramping up. But then in year 3, we have $10 million in revenue. Oh, in year 4 is $100 million. So, I suppose that could be true, but that's probably unusual to basically start out so small and then skyrocket. Not every company is a Tesla. So I would suggest to have a more reasonable ramp and a more reasonable set of projections that you think you can somewhat realistically see yourself achieving, because you don't want to go selling to investors or even to your fellow management team, here's what we're going to do, next year, and then achieve 2% of it. That's very demotivating. So you want to be realistic in your numbers, and again, kind of a reasonable ramp of time to achieve those. And that way you'll be viewed as more credible and more, bankable or realistic by investors. And I just happened to build you a template or a model that's been posted online by Allison. It's somewhere on the CMU website, but this presentation, the model I'm going to refer to in the presentation and show you some of, and the cap table example are all posted for your use. So let's look at some assumptions. What you need to do is document your assumptions in the model. Don't just assume that you're going to remember everything, because when you build out maybe 4 or 5 tabs in a model, you will remember everything. When you've built out your 24th or 25th tab in a model, you probably won't remember everything. And you want your audience, the reviewer, maybe an investor, to be able to pick up your model, look at a tab that tells them the relevant or the main assumptions, and then they're able to view the model on their own. You don't want them to look at the model and say, wow, this is one complicated model, and I don't really understand much of it at all. So I'm going to have to call up the company, and we're going to have to go through it, tab by tab, because it's just so darn complicated. So you don't want it to be complicated. You want it to be relatively simplistic and to document your assumptions. And I'll show you how to do that. What type, in your assumptions, what type of company are you going to create? Hardware, often when I'm in person, I can do this easier, but we can always build, the next iPhone here. Is it going to be software? Software is a lot easier to get up off the ground than a hardware company. Is it going to be a consulting practice? That's even easier to get up off the ground than a hardware or a software company. Are you going to build apps? A lot of businesses build on that. Are you going to have a coffee shop? That could be the lifestyle business you want to have, and that could be fine. So the type of company you're looking to create or found or start has great relevance to how you're going to build your model. In terms of a product or service company, so just a little little question for the crowd. What do you think is typically more valuable over time, a product or a service company? Does anyone care to weigh in? I don't hear a lot of weighing in. So I would submit to you that a product company probably is. It's not that a service company can't be, but normally a product company, while a much heavier lift in the beginning and a lot more capital intensive to get off the ground, and probably even a longer sales cycle, at least in the near term. So there's a lot of hurdles in the beginning, but in the end, all of that cumulative work usually results in a company that is worth quite a bit more than a service-oriented company, such as a consulting company. And in a service company, it's often that I kind of call it, you work an hour for an hour's pay, or you perform an hour of consulting for an hour's consulting fee, or you perform a 40-hour project for a 40-hour priced project. So to me, product companies, you can leverage the technology, and that once it's built, which again is a heavy lift, can really take off exponentially. Are you going to build or buy? In the case of a product, are you going to build or buy it? Building it's pretty darn tough, because now you're talking about, let's go to my phone example here. You're going to have to build out manufacturing capacity, tooling, equipment, manufacturing line, facility, plant, shelving, all sorts of things just to be able to build it, let alone build it. So what I would probably suggest in the early days, if you can buy product off the shelf from other suppliers, from one or many suppliers, that's probably the way to go, at least if you're able to do that. Now, if you're building a product that's completely novel, that's going to require your own custom developed parts, then that is a different story. And that certainly could be a very attractive path and an advisable path. But to the extent that you can take off-the-shelf components and assemble them in a unique or patentable way, that's easier than building all your componentry from ground zero. I kind of think that makes sense. Are you going to build your revenues through a direct sales team or partners? So in other words, are you going to plan on building out a number of sales people in that model? Every salesperson is good for $1.2 million of revenue. So if I'm going to do $12 million in year 3, I think I need 10 people, because 10 times 1.2 is $12 million. That's maybe one way to think about it. Or am I going to use partners and just let other parties sell it? I would submit to you that in the early days, it's best to look at going through your direct sales team. Why do I say that? If I can get back to where I was. Why do I say that? Well, because no one's a better subject matter expert on the product or service than you. A reseller or a partner isn't going to know it as well. That's number one. Number two is, you're going to hear some yeses, as you'll close some deals, but as importantly, you're going to hear why some potential customers are saying no. In other words, you're going to get contentions, you're going to get critiques, you're going to get challenges, and they're going to say, I like 50% of what you're doing, but the other 50% of your solution would be great if it addressed these two things. A partner is not going to be able to react to that. So I would suggest for the first couple of years, or for the first few million in revenues, or at least for the first 10 plus customers, you sell yourself so that you learn all of that, get that cumulative knowledge. Then you can employ resellers or partners that you can coach up to how to answer, kind of like give them FAQs, frequently asked questions, on here's what you say when a customer says this. So you can actually arm them with all those materials in your experience, so they can more efficiently and effectively sell your product or service. Most partners aren't going to get real jazzed if they can't sell it relatively quick. Why should they? They're not going to spend effort on something they can't make money from. Partners and salespeople are coin operated, is how I say sometimes. What type of and how many employees do you need to build your company? Well, employees are expensive. So that answer right there is going to be a big part of your expenses. Just know that everything we're talking about here is going to affect your cash needs. And I don't think I'm going quite to the model yet, but this is a snapshot of what I'm going to show you in the model that just is contained in a tab called Notes, or it could be called Assumptions, or it could be called Index, whatever you want to call it. But it's something that lays out kind of a table of contents or an explanation for the reviewer. You know what I might do? I think I am. And let's go through this slide. Sorry. So further on assumptions, what tools will your employees need to do their job? Well, if you're going to be a software development, you're going to develop software, you might just need your laptop, maybe an external keyboard, a docking station and a monitor, and maybe a mouse and a chair. So you can actually kind of get up and running fairly capital light if you're going to create a consulting or a software development company. I mean, there will be some servers you need to use and data repository and things like that, but a software company is not real capital intensive to get up off the ground. But know this, employees are going to ask for a lot. When we formed our cybersecurity company, I told everyone, I said, and we had 7 co-founders, by the way, which is way too many co-founders. I told the team, I said, this is going to be a BYOC startup. And they're like, what? I'm like, bring your own computer. So the company's not going to pay for computers and stuff. Bring your own. You've got one, so use it. And you've got your own phone, so use it. So we got up off the ground really cheaply. But what you'll find is when you form your company, let's say you have a co-founder. So let's say you and a co-founder. You two will do probably whatever it takes to get the company up off the ground, and probably involves, spending your own money, not even taking a wage, and talk about skin in the game. That's going to be who you are. By the time you get to employee 10, 15, 20, 25, 30, you're going to find they become more expectant. In other words, they're more reliable on the company mothership taking care of them. So they want the latest laptop, the latest MacBook Pro. To heck with a 13-inch screen. I want a 17-inch screen. And I want a big monitor. In fact, forget that. I want 2 big monitors with the latest, technology. And, sitting is the new smoking. So I actually want a desk where I can stand, and it's way too difficult to crank a desk up. So of course I need an electric one with a push button. And you know what? That was 5 minutes ago. Now I've decided I want a treadmill desk. Yeah, that's exactly what I want. In fact, I want a treadmill desk. And actually, if I'm really thinking about this, I want a Peloton equipped with a stand that I can put my laptop on so I can actually ride my bike while I work. So you're going to get a lot of ridiculous requests from employees. They're not shy. If you haven't been in a company before, employees ask for pretty much anything. So you're going to have to learn how to say the word no a lot. Where are you going to put employees, and how long are you going to stay in that space? Guess what? The world changed starting 12 months ago, didn't it? So companies that were looking for space are now, the companies that were looking for maybe a 10,000 square foot office are now looking for, maybe 2,000 square feet. So a lot of us are remote. Everyone I think here on this call is remote. I've been remote for most of the last 6 months at my company. I'll probably be remote for at least the next 2 months. I may be part remote for the rest of my career. I don't know. So boy, that line right there, since I wrote that last year, has changed a lot. And you're going to have to be flexible to that. Again, the physical environment, it's TBD right now. Right now, it may just be mostly remote. What kind of data or telecom infrastructure will you need? Zoom has been working pretty well, hasn't it? So, Zoom and cloud services, you may not need near as much as you used to. What kind of marketing efforts are you going to need to get mind share into your company? You know, the days of in-person trade shows and big events were already going away pre-pandemic. Now, I think, boy, that industry's probably taken a big, big, big hit. And I would suggest a lot that used to be in person is now online. And even before then, like I said, social media, B2B activities, B2C activities, a YouTube channel, a LinkedIn video series. A YouTube channel is really effective. And the reason I say that for marketing is you can create a YouTube channel relatively inexpensively. You and your founders or your CTO or your VP of sales or whatever can get on there and do, say, 2 to 3 minute subject matter expert clips. And when I say subject matter expert clips, I mean, don't post videos that are just you selling, you know, your product or service. You'll get tuned out pretty fast. That's kind of tantamount to cold call selling. But if you portray yourself and build credibility as a subject matter expert over time, you know, every week this company is giving a helpful piece of information on this particular subject. Week after week, we're subject matter experts. Here's what's helpful. Here's the latest happenings in our industry. Here's the latest tech coming on board. Then eventually, once you're trusted as a subject matter expert that gives good, somewhat objective advice, then you can kind of slip in your sales process. So marketing efforts can be relatively inexpensively and easy to get off the ground. Will your sales team travel? Again, travel was down before the pandemic. Now travel is, you know, really minimal. So I think this is going to change too. It's interesting. From the time I even presented this, maybe not last October, but last March, a lot has changed, like I said. But know this, all these assumptions are big ticket costs that are going to affect your cash. And again, you're going to learn how to say the word no to your employees. And speaking of cash, sometimes I kind of playfully do this. A lot of people say cash is King Kong. And I say cash is not only King Kong, cash is not only king. Cash is King Kong. So I pound the table when I say that sometimes. Again, some people say cash is king. I think it's King Kong. I didn't do that too well. So why don't we go ahead and look at the model? We're going to go out here. Is everyone able to see and hear me okay still?
Yep.
Okay, good. Yeah, it always helps to get just a little bit of feedback. So I'm going to go to the model, and hopefully you can see the model. And of course, whoops. And of course, it's never as easy to see if you're on a laptop. So I'm going to blow that up to 140%, trying to get that big enough for everyone. In fact, 150%. So this is the model I'm talking about. And again, it's available to you. Here's what I want to point out. I've actually interacted with a few people after I've made these presentations, and they've actually sent me my model back, and they've inserted their own information. But what I find interesting is when I go in and I find there's still some of my information in their model. That's not good. You don't want investors to see that. You certainly don't want to see a cell that says, you know, that Phil Compton was the author. So probably need to change that. I don't have a lot of those notes, but you need to look out for those. And by all means, you know, as I say here, this model is a template, contains hypothetical data to illustrate how formulas work. You'll need to change and insert your own data. If you take the revenue I have in here and use as your own, you're in trouble, because I'm only doing it as an example. So I know I'm kind of beating that like a dead horse, but please use your own information. So the purpose of this tab called Notes, if you can see that, Notes at the bottom, is to serve as again, an index or an explanation to the reviewer, such as, and let me keep going, sorry. So in row 21, variable input cells are mostly in blue text with green background. So what that means is anywhere in the model you see a green cell, that's I think always that's an input cell. If you input information in there, then the formulas replicate the data and takes care of it. Another thing I want to point out is down here in row 49, if you can see that, funding or cash flow. No funding is yet inserted into this model. So what I wanted to do is let you see what your projections result in. In other words, let's see how much cash you're short or cash you need to raise or funding round you have to go after. So don't get alarmed when you see a lot of red at the cash line because I haven't inserted any funding. So again, this serves as kind of like I say, an index to the model. For example, in the first sentence here, or the first note here, the statements sum and statements monthly tabs contain a detailed and summary monthly and quarterly income statements, balance sheets, and cash flows for 2 years. So, and then if we go to the statements monthly tab, this contains several calculations at the bottom that provides support to certain items in the financial statements. And if we go to revenue, revenues contain a fairly straightforward revenue model, and I have a named forecast. I'll go over that. Sorry about that. I have to set alarms for myself, or otherwise I go past. So I know those are noisy, but I guess I'm doing that. All right. So yeah, so the revenue tab is going to be a very important tab. So why don't we go ahead and go to the revenue tab? But just in summary, these are notes that help document your assumptions, help you to remember what you have assumed, and probably even more importantly, help to notify the reviewer of what you have assumed. So let's go to the revenues tab. And I'm blowing that up to 130%, 140%. How's that? So hopefully everyone can see that. I'm calling this the named bookings and revenue forecast, or in other words, named forecast. What the heck's a named forecast? A named forecast is when you're actually going to go through and insert customers, or I should say, candidate customers or prospective customers or prospects' names. And you won't have those maybe day one starting out your business. But eventually, as you start talking to candidates or possible future customers, you'll be able to start filling in some customer names. Again, you're not going to have it maybe the day one, but over time you'll fill some in. The top of this, let me go back. So customer names. There's also a room for type of product, and you'll see here I have a list, a drop-down list you can pull from. And this, I'm trying to make this as flexible as I can for hardware, software, consulting. I just kind of went with a software company with services. So that was kind of my template here. And the drop down here I have, you can have, software product number 1 and 2 and 3. So I gave you 3 versions of softwares or 3 flavors of software. Implementation fees to maybe, charges or fees you would charge your customers to integrate or implement it into their infrastructure or ecosystem. Excuse me. And then consulting fees, you might go in and say, hey, even though I'm going to sell you this cloud-based software, there's still, there's still ways you can use this in your company or with your customers that you can be of a consultative nature or actually charge the customer consulting fees. So I've given you some choices there. There's also a close date here. When am I going to close this prospective customer? Right now, you can see that March 1st of 2020, again, you can change the dates, but March 1st of 2020, this deal to this customer 1 is going to close for that product at that amount at this date. So if I change the date to, let's just say 5/1/20, you can now see that sale moved over to the May 20 slot, okay? And if we decided, you know what, hey, this first customer, they're going to be bigger than we thought. This is awesome. So I'm going to, now it's a $60,000 deal that we're talking to them about. So now it's May of 20, $60,000, May of 20, $60,000. So this is already formulaically all set up. If you look at these formulas right here, all you have to do is enter information in the blue and green. Now, all you have to do. I'm kind of joking because it's really hard getting your first customers, but at least in the model, it's going to be easy to enter that information. This cell is interesting in that I call it the CEO toggle. Well, what the heck's the CEO toggle? The CEO toggle you can use to run what if scenarios, or in other words, stress test your model. So right now, if you can bear with me, if we look at the total, if we look at the total bookings I have for this first year of 2020, they are what does that say? $280,000. See that cell? So if I go up here and say, let's just see what happens if our revenues are only 50% of our goal. So 50%. So now that $280,000 has become $140,000. So you can make this cell, 90, 80, 70, 100, 10, 120, whatever you want to do. I've simply put it in here so that by changing one cell, you've already changed the bookings for your whole company, the revenues for your whole company, and even the cost of sales for your whole company. So I've got you all the way down to gross margin just with that one cell. So it's all built in. So bookings versus revenues, what are you talking about, Phil? So the top section of this tab, again, this is the most involved tab, is for bookings. In other words, you sign a contract with a customer, you book, that's what it's called. You book the contract or close the contract, you've now got a booking. That doesn't mean you have revenue yet. You actually have to act on or fulfill the contract or fulfill the booking. So a booking is upon fully executed contract. You've got it booked, but nothing else has happened. I then have a lower section down here, if you can see where I'm going, right down to row 100 here, and you'll have this model, where the revenues are then calculated from the above bookings. So remember how that customer one closed at March 1st for $40,000? That's down here. And I'm assuming a revenue term, if you can see my note there, it's kind of small, the period or term over which revenues are recognized. What I did is I assumed that this is a 1-year subscription software. I had to pick some kind of example, so I picked a 1-year subscription software model. And there's 12 months in a year, right? So what I did is I took the above bookings. If we look at my cell here, I took the above bookings right there. You see it's highlighted, divided by 12, starting in June of 2020, which I'll explain in a minute. And I spread that over 12 months. See how they're all the same? 3,333 times 12 is $40,000. Well, why did you do it in June and not in March? What are you doing? What I did is I assumed that revenues occur 90 days after a booking. So let me repeat that. You've signed the contract, you've got the customer ready, but they're not ready to go, or you're not ready to deploy them yet. So sometimes it's good to allow for a lag or a period of time from contract signature date to customer, if you will, deployment date. So in this model, I've allowed for a 3-month lag. You can do whatever you want, but I think that that's probably a reasonable expectation that it's going to take 90 days to get a customer up and running. That's not a crazy assumption. So again, this is probably the most important tab in the model. That's why I've spent time on it. And it's got a lot of variability, which you can use for your own. This probably the second most important tab, and I want to be respectful of time here, is the employee input tab. So the employee input tab, I'll blow this up to 140% too. The employee input tab is basically almost the same thing. Now you're projecting out your hires. So revenues are the most important figure for a company. No revenues, no company. No revenues, no fundraising, or at least eventual revenues. You're probably going to spend about 70% of that fundraising on people. People are usually about 2/3, maybe even up to 80% of your spend. So that's why I'm saying employee input's probably the second most important tab. And let's just say, you're the CEO and you've got a CTO, you're the two co-founders, and You were hired on 1/1/20, here's your salaries, if you even have a salary. At my startup with a cybersecurity company, my salary was 0 for the year. So 0 is pretty low, just so you know. It was 0 for a year. In fact, in all honesty, I paid to work at my own company. So it actually cost me money to work. I didn't get paid for it, it actually cost me money. So now, luckily, I did have stock, and that ended up paying off some, but I lost an entire year's worth of my market salary. And you may have to do that in forming your own company. But what I wanted to show you here was, so let's just say you're going to hire employee number 3. You've got you and your co-founder, let's hire employee number 3. Put their name here, their title here, who's their manager, what department are they in? We'll go over departments. When are they going to start? I have them starting in March of this year. At a $70,000 amount equals, that's 70,000 divided by 12. If I change that to June 20, boom, it goes out to June, then you can see there. So again, this is just like the last tab, fill in the greens, get the results. So that's all set up for you. I not only have a section for employees, I have a section for contractors. And that's something I would bring up here. As a founder, if you all in fact are looking to be founders or have started a company or are already in a company, I would advise to try using contractors, consultants in the beginning as much as you reasonably can. Now you're going to find that occasional, versatile athlete that you don't want to miss out on, and you want to lock them in and you don't want anyone else to have them. So you're going to hire them as an employee. That's great. And actually that's a fantastic thing. But you may also be like, you know what? I don't know about this guy or this gal. They seem awesome, but I just don't have a great feeling. So I'm going to hire them as a contractor. They're going to be, 50% work half time. And I'll engage with them for maybe 3 months before I decide if I want to go up here and hire them. And I think that's a real advisable path to take. Start out slow, be kind of, slow to hire, fast to fire. I don't want to get into HR too much, but I think that's a mentality that you should probably have as a founder, is to not commit contractually to too many employees too fast. Because once you hire someone and it doesn't work out, that's not a pretty scenario. So I'm going to go away from the model. There's a lot more I could go over, but again, it's already 1:15. So any questions so far? Okay, well, I'm going to go ahead and go back to the presentation here. And in 5 minutes, I'm going to get to the cap table.
I actually did have one question,
yeah.
if you have a moment.
Of course I do, yes.
You mentioned a comment earlier how during one of your startups you had 7 co-founders and that was too many. Do you have an idea of what like the sweet spot is? If you have a group of people who maybe are all kind of interested, but maybe you don't want to jump in with all of them, you want to find a smaller group. Do you have an idea of how to go about doing that?
Yeah, trust is a huge thing, and I mean huge, underlined, bolded, and in italics. So I've been employee number probably 3 through 10 about 5 different times. I was employee number 19 to my current company. So I would say 3 or 4 feels about right. I mean, I know that's not very scientific, but I just think more than that, and you're just going to run into a lot of personality issues, a lot of trust issues. You don't have as good of a feel for what everyone's doing. I mean, I had my cybersecurity company, one of my co-founders had another job. I mean, here we all are working without pay, and he doesn't care because he's making $80K at another job. He lied to us. In fact, in our employment agreement, it says, you as a founder will give 100% of your efforts to this company, blah, 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 no other outside activities. He was 50% elsewhere. I had another co-founder, and this is really scary. We were meeting with potential investors, and we all went to lunch. And on the way into the restaurant, he goes, hey, Phil, my wife and I are looking at lake property in North Carolina near Charlotte. He goes, when do you think we're going to exit? I'm like, Did you just ask me that question? We don't even have our initial funding yet, and you're talking about when we're going to cash out? I ended up terminating him 3 months later. So good old Phil, the CFO, was charged by the CEO with the messy thing of firing 2 of my 7 co-founders. So get back to your question. It can get messy. I'd say 3 or 4.
Thanks. Thanks. That does sound quite messy.
Yeah.
I have a related question. What do you think about being a solo founder of your company?
I think that's noble, a little bit idealistic, and by the way, doable, absolutely doable. So please, and these are Phil's opinions. Phil's not perfect. Phil's not always right, but in my opinion, you will find great benefit in just having at least one other person involved, because right now you're literally having conversations with yourself. You might even be looking in the mirror saying, here's what I want to do. And then the other side of your brain is like, I don't know if that sounds very good. And then you'll say, what, but I really think this will work. So you can only talk to yourself. I think it's good to have another trusted, somewhat critical partner that can exercise your thoughts and your assumptions so that you're not acting in a vacuum. Now, having said that, no one's going to try to start a company without any outside influences or opinions, right? I'm sure you're talking to 5, 10,
Right.
15
Incubators, accelerators, mentors, coaches,
Yeah.
like other entrepreneurs. Of course, I agree that you cannot just do it in a vacuum, and definitely like little bets along the way are the key. It seems that the advantage may be that the person is then in charge of the company, so you kind of prevent the possible disagreements.
Yeah. So, hey, you're right. I probably get along better with myself than anyone else. That's true. But I think we all do. We pretty much agree with what we think, right? So I think that the use of mentors and advisors helps, and you're doing that, and I think we all need to do that. But I do think it helps to have someone that's literally feeling every step, every pressure, every win, every celebration, every scary moment, every exhilarating moment with you, because I just think, a good one plus another good one might equal 3. You might find it's actually exponentially better to have that one other person. And in the very end, while you want to have control and, you might trust yourself to be the best at what you're doing, and that may very well be true. It might very likely be true. But in the end, you get more, you can only get so much done. So you really get work done through people. And that involves, of course, bring in more people. So there's Phil's opinion for what it's worth. So,
Thank you.
Sure. So I think I'm going to go through one more slide, then get to the cap table again. These sessions seem to go really quick. Oh, and I wanted to show this one. Oh man, I like that one. But what I'm going to do is go to terms you should know when you're talking to a potential investor. And again, I don't know any of your situations, but here's a slide you want to pay attention to. So the first is, if you're going, in front of investors, which, in the old days, we actually used to really sit like right in front of them. Now you're going to be remote, almost surely. They'll say, okay, well, I've looked through your model and everything, by the way, whoever built this model did a pretty good job. At any rate, you're going to go through the model. I'm kidding. You're going to go through the model. They're going to go through the model, and they're going to say, okay, hey, I've got some rapid fire questions for you. What's your burn rate? What's your runway? It's like, whoa, slow down, cowboy. So the burn rate is the amount of cash you're consuming in a given month, or it could, what I would really say, it's probably in a given month over a quarterly trend. So think about 1 month. I mean, a year isn't made in a month, but 3 months do develop a pattern, right? If you've done something or spent money at a certain level for the past 3 months, that's a trend. If you're projecting to spend a certain amount for the next 3 months, That's a trend. But you may have a really expensive current month and not nearly as an expensive second month just because there were unusual expenses needed in that 1 month. So I think averaging it out to a quarter's average for a month. So if you're spending $100,000 a month over 3 months, well, that's easy math. That's $100,000 a month. But if you're spending, 800,000 over 3 months, is that what 283,000? I think that's the number. So you'll want to take the average. So the burn rate is everything you're spending, the money on all of your cost of goods sold, the cost of building Phil's wonderful phone he's talked about here, the cost of all your people and your operating expenses. Sometimes those are called departmental expenses. The money that you're spending on CapEx, those wonderful Peloton desks that employees want, that's a capital expense. And any current debt obligations. In the beginning, you're probably not going to have debt, but that would be included in burn rate. Then you can say, hey, investor, on average, I'm spending this much per month, or in the next quarter, I'm going to spend this much per month. Okay, great. What's your runway then? Mr. or Mrs. Entrepreneur. Oh, okay. The runway is the amount of cash you have on hand right now divided by the burn rate we just talked about. So real simple math, if you've got $1.2 million in the bank and your burn rate is $100,000 a month, let me think. You have 12 months of cash. There's my second alarm. You have 12 months of cash left. If you increase that burn rate to $200,000, guess what? $1.2 million divided by 200,000 is now 6 months. Ooh, that sounds a little bit more scary. So you'll want to know your burn rate and your runway, and you don't want to be raising money where it doesn't even last for 5 or 6 months. That won't look good on yourself. A couple more terms we want to think about when we're approaching investors is EBITDA. EBITDA is, think about that as income or loss from operations. In other words, what are my operations going to cost me? Revenues minus the cost of my product equals my gross margin or my product margin, minus all my cost of operating or running the company equals operating income or loss. That's also referred to as EBITDA, more officially. Earnings before interest, taxes, and depreciation and amortization. The thinking is your daily operations don't depend on the tax rate that some government determined. So that's not really an operational expense. The interest that you're charged on a bank loan isn't the least bit indicative of your daily operations. That's just an interest rate you had to sign up for to get a piece of, a loan. So income from operations is meant to be what it takes or the results of running your company. And break even, again, it's not just when you happen to have, oh gosh, I've been unprofitable for 30 straight months, and in month number 31, I'm profitable. So I'm now EBITDA break even. Not necessarily. What I would say is once you've reached break even for, say, 3 months in a row, now you can consider yourself break even. You might dip down a little bit, but you've kind of reached break even. It's going to fluctuate. Same thing with cash flow. And by the way, you will be probably profitable on your books in your accounting records before you're profitable on a cash flow basis. And that's because almost any activity your company is going to undertake, you'll be spending the money before you see the benefit from it. If my staff designs and builds this wonderful phone, Phil's phone, I'm probably going to spend 95% of the money to get that ready before I ever make a sale. Think about that, 95%. So you're going to burn money before you sell, and then you've got to collect the cash. So again, remember my King Kong statement, cash is King Kong. So anyway, I know that was a lot to go over. I'm now going to pivot in the last few minutes, and you're welcome to stay on for a few extra minutes, to the cap table. And I'm going to do that as fast as my laptop will go here, and I'm making that bigger. Can everyone see that?
Yep.
Okay, so thank you, Chris. You're a good communicator. Thank you.
Thanks.
So real quick, this, I'm going to delete some cell, blah, 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 blah. Right now, you've got a company, let's just assume, let's say you've got yourself and a founder, whoever you are and a founder, and you've each got 1 million shares. And by the way, again, for the sake of time, most companies when they start up will, it's called authorize 10 million shares of stock or 10 million membership units if you're an LLC. And you're thinking, well, gosh, why 10 million shares, Phil? It tends to work out fairly well in terms of the amount of equity you end up granting and selling to people. I mean, you know what? Equity is actually percentage based. So you could actually issue 1 share, you could have 1 share in a company, and then you and your founder can own, you know, half of a share. And by the time you end up hiring your 20th employee, they could own 0.00001 of a share, but that kind of sounds stupid, right? So we want to have enough shares so that, you know, you'd rather issue someone, hey, you get 10,000 shares when you start the company, as opposed to you get 1/10 of a share. It just doesn't sound right. So let's just assume that's a good number to go with. So in the beginning, you and your co-founder have 1 million shares apiece. That's 2 million shares. You own 100% of the company. Hey, we're total owners, 100%, no problem. Wow, we don't have any other employees and we don't have any money. So I think we need to go maybe add a couple of people to the team. So I'm gonna hire, let's say, 4 other people, and I'm calling them management. They don't have to be management, but let's hire 4 other people at $125,000 a share. That's my guess. So that's 500,000 shares we've just added. Hey, the founders, we're still 80% owners. You know, that's still most of the company. That's great. Okay, well, then you're going to raise a little bit of money from some friends and family and sell them stock cheap in the beginning, 100,000 shares worth. And again, this is all shares and percentage. We're not talking dollars yet, even though dollars would be involved. So now you're like 77%. Okay, well, you know, that's cool. My friends and family have about 4%. Okay, life's still good. Okay, well, wait. You now need to hire some other people, and you need to authorize an employee option pool. You've heard of that? And so we're going to authorize 400,000 shares. Just take that for what it is. And that pool now equals a total of 13% of all the shares. By the way, the sweet spot for an employee option pool is between 10 and 15% of all shares outstanding, of all shares authorized. That being that you want to have a pool that you can draw from to, if you even choose to offer equity to employees. You may not, but you know, most tech companies do. If you choose to give out options, you'll need to have a pool authorized. And some of those are going to be eventually granted, in other words, actually issued to employees, and the rest will be ungranted or not issued and not outstanding is a way to describe them. So now that you've created that option pool, it's like, oh, geez, wow. Okay, well, we still own 2/3 of the company, us 2 co-founders. And you know, that still feels pretty good. Okay, yeah, so we're good. Okay, well, now we're gonna do a funding round. So let's look at that funding round. And again, this is where Phil is making this easy for you guys. So anything is a green cell is an input cell. Well, there's only 2 cells here. Let me explain. So pre-money valuation, we're going to come back to that in a minute. Right now, I've got $2 million. I'll explain. If you take $2 million divided by, see the 3 million shares from over here, it just comes across. If you take $2 million divided by 3 million shares, you get 67 cents a share. That's math. And if you're looking to raise $500,000 in new money, I'll explain that in a minute, that money is then worth another 750,000 shares. That is the calculation of the money you've raised, 500,000, divided by the price per share equals the number of shares. So, whoops, sorry. So that is a fixed amount. And that stock buys 20% of the company. That is math. The post-money valuation is the pre-money valuation plus the money raised, that is math. The amount of option or shares outstanding after the round, with the amount of shares outstanding before plus the amount of shares sold, that is math. So really a lot of this is math. And now if we look at this, we've raised $500,000 in this scenario. Okay, well, what does that mean? Well, what that means is if I take those 750,000 shares I've just sold at 67 cents a share for $500,000, that bought 20% of my company. Well, wow, oh geez, wow. Us two co-founders, we now own 53%. You know, I kind of we want to stay above 60%. Okay, well, let's go back to the drawing board. So there's only two levers to pull, guys. There's only the pre-money valuation amount or the amount you're going to raise. You know, there might be some other things like warrants and stuff, but we're going to keep it simple. Those are the two levers here. And there can be convertible notes, but that's another discussion. We're talking just a straight out funding round here. So now we're finally to valuation. Well, how do you calculate valuation, Phil? It's complicated. So in the older days, it was more quantitatively driven in that there weren't that many companies out there that were unprofitable for an extended period of time. There's probably more now than there has ever been, or at least since the tech bubble days in the late 90s, early 2000s. A lot of companies are growing very fast and they're growing very far without being profitable. So valuing a company on the traditional method of a multiple of earnings, I tell you, that's getting harder and harder because a negative number times anything is a negative number. So that's not really going to work for a while. And multiples of revenue, you know, I may be purposely foregoing revenue so that I can build user adoption. So at the beginning of year 3, boom, I launch and I've got revenues. But until then, I don't have revenue. So 0 times any number is going to be a pretty low number. I think that's called 0. So you're going to find yourself in this day and age being as much qualitative in trying to defend your valuation as you are quantitative. And that drives investors nuts. They're used to models. Qualitative doesn't fit in a cell. It doesn't fit in a formula. So the best advice I can give, and I'll probably get questions, is negotiate your rear end off, but at least have, you know, a comparable story as to the early stage point of some companies that you might consider somewhat comparable to you and what their early funding rounds were priced at. So that is at least one, you know, a figure or event to peg your activity to or your valuation to. It might also be that you simply have to go in, sell your vision and just try to dig your heels in and defend that valuation as much as you can. Because in the back room here, when we're calculating dilution and you're looking at that 53% over here, here's how we're going to have to make it work then. So let's just say we can, you know, we haven't shown this to investors yet. Let's make this $2.5 million. Surely that'll get us 60%. Oh, geez. No, it didn't. Wow. So 56%. Wow. Well, okay. What if we just let's just go ahead and raise $750,000. You know, we could always use more money anyway, and that's good. Yeah. Oh, well, gosh. Well, when we raise more money, we sell more stock. Oh, I went backwards. Yeah, you do. When you raise more money, you dilute yourself more. Boy, this is Phil said this wouldn't be easy. It's not easy. So let's go okay, well, we're going to dig our heels in $3 million. $3 million. I think I'm back to where I started. Oh my God, this sucks. So you can see you're going to have to play with these levers, and you know what you're going to have to probably decide in the end. We're not going to be able to keep 60%. What we're going to, however, think is we and management and our family as a team own, what is that? 70%? That's good enough. We're going to have to change our thinking. Founders can't always keep owning a majority of the shares. They may, there's exceptions to anything I'm saying, but over time, you can see how dilution occurs. And I'm not raising that much money. It's just I don't have much of a valuation to defend myself yet. So I know that was a lot. I know that was quick, and I'll open it up to questions from there.
Just to clarify, when you say negotiating, you're negotiating the pre-money valuation with the investor.
Yes. So and you're right. That's interactive. You're probably not going to have the good fortune of just saying, "Hey, 5 investors, I hereby declare my pre-money valuation, starting out with no product, service, or employees. I'm going to say that I'm worth $3 million," and they're going to say, "That's humorous. How did you come up with that?" So then you're going to say, "Well, based on my revenues 3 years from now of $1.5 million, I've determined that in my vertical, it's common to get a 2 to 4 times revenue multiple in terms of valuing my company." So I went with the low end. I went with 2 times $1.5 million in revenue. And they're like, okay, well, that's 2 years away. Does that mean that's what you're worth today? And you're like, yeah, that's what's going on in the market right now. Companies in the attractive vertical that I'm involved with are getting valued on years 3 or 4 revenue. So I'm actually giving you a break by saying year 3. So you see how this just kind of goes back and forth. And right now, I'm actually involved in some fundraising where I'm actually, to be honest, I'm living what I'm presenting. It's a lot more complicated and there's more zeros involved, but I'm actually living what I'm presenting here today. So I'm going through negotiation of our pre-money valuation. I'm going through how much money we're going to raise. I'm going through which potential investor we're going to get involved with. I'm going through our current investors feeling like they don't want to get diluted any more than they already are. So I'm living what I'm teaching here today.
That's really interesting.
Yeah, and it's really fun to look at this, and it's also kind of scary because you're thinking, again, in this situation, I'm not even raising that much money. How the hell can I get diluted that fast? It's math. It's just math. So what you are building your model for, and finally the tie-in here is, I would not raise any more money than I am projecting to need for the next year. So that's 12 months. So if my model said I need to raise $600,000, in other words, the lowest point in my model that Phil gave me, that the lowest model of cash was $600,000. Well, I'm not going to raise exactly what the model says because I already know the model has faults. I'm going to raise $750,000. That's, what is that? Is that 25% cushion, I think? So, I've given myself some cushion. I'm hearing Phil in my head. He said, raise more money than you need to. So I've raised that. But man, this pre-money valuation is problematic when I raise that $750,000. In the end, you need to raise what you need for about the next year. In the end, you need to raise a little bit more than you're projecting to need. And in the end, you're going to have to get over your dilution concerns some and worry about building the biggest pie, because your equity can only ever amount to 100%. So if you can't increase or modify your percentage holdings to where you want to be, here's the answer: make the pie bigger.
Yeah.
And probably the way to make the pie bigger is to raise money, hire employees, get the product or service out there, get customers, make them raving fans, they pay, rinse and repeat. So what other questions do we have?
Thank you very much.
Sure.
I have a follow-up question on that for the evaluation. So you mentioned that you would come up with your own valuation based on other companies in the vertical. And then, of course, you have your forecasted amount for your expected revenue minus cost, profit, and so on. So what other factors would you look into when you're coming up with your company's valuation?
Well, and by the way, it doesn't have to just be revenues. That's actually an easier explanation. Sometimes investors will say, revenues are great. What if you're not profitable? So actually, I want to talk to you, Mr. or Mrs. Entrepreneur, about a multiple of your EBITDA or your free cash flow or your cash flow or some other measure of profitability. And then you're going to think, I was afraid you were going to say that, because we actually aren't planning on being profitable until year 4. And then they'll say, interesting, huh? Well, in that case, are you worth nothing then? Well, of course, that's silly too. So you're just going to have to find the happy medium at which you can dig your heel in, make your case, have it be a multiple of revenue as opposed to earnings, because I'm going to suggest to you that's probably the way to try to go in the beginning, unless you're modeling and truly think you will be profitable in a relatively near term, which I would say near term can be considered within 3 years. So that can, I think near term, 3 years is about the max you can call near term. So if you can reasonably project that you're going to be profitable, and it's just a projection in 3 years, you could use that multiple. But again, if you're projecting to, let's just say, you know, generate $100,000 in EBITDA in year 3, and the typical multiple in your vertical is 4 or 5 times, 5 times $100,000 is $500,000. That's not a good answer either. So you can see how it's going to take a combination of factors. I don't think it can just be quantitative unless you truly come out of the blocks and have a bit of an out of the norm revenue trajectory and profit projection. What I've said here today is a little bit more conservative in terms of how fast you should forecast to ramp. The reason I'm conservative is I've got these little thing called 37 years of experience. I've got several scars from all these experiences, and very few people ever meet, let alone exceed, their original projections. And guess what? Those investors are really good at bringing up, hey, remember that nice, cute model you showed me in March of 2021? I know it's July of 2022, but I'm kind of still holding on to this. And you didn't meet that too well. So in this second round of financing, we're going to do valuation my way this time. So again, there's exceptions to everything I'm saying, and your initial valuation is not as clean and neat as textbooks would have you sometimes think.
Okay, thanks, Phil.
Yes. What else do we have? About any of this, not just the cap table, but the model. That this, you know, this wasn't necessarily a presentation on just cap table. Any questions on the model? Okay, well, I know we're already a bit over, so I'll turn that back to Allison.
Thank you, Phil. This was great. I think everybody learned a great deal of information. So thanks everybody for joining us, and thanks Phil for joining us today.